Hi, everyone, and welcome to the week ahead. I'm Tony Nash, and I'm joined by Tracy Schuchart, Nick Glinsman, and Albert Marco. Before we get started, I'd like to ask you to subscribe to our YouTube channel. It helps us a lot get visibility, and it really helps you get reminded when a new episode is out so you don't miss anything. We had a lot this week. We had tech earnings, some really interesting tech earnings and market activity as a result. We had crude really ripping this week, and we had bonds raging at the end of the week. So really a lot happening across sectors and asset classes. So let's start with the bond market, Nick. We seem to have gotten pretty much what you mentioned on last week's show. So can you go into kind of what's happened and what's happening in the bond market right now?
Yeah, we've basically, they've been ambushed by inflation. That's what's happened. You saw yesterday out of the ECB, which was a hawkish twist, possibly one of the worst press conference performances I've ever seen in my life. But the facts of the matter are you've got 5, 6, 7% inflation in various countries of the EU. In Lithuania, you've got 12%. Okay, so they're failing at their predominant original mandate, which was inflation per the Bundesbank. So from what I've been told, there were several members of the MPC.
Sorry, when you say she, you mean Christine Lagarde?
Christine Lagarde. Several members of the MPC wanted to move yesterday. Not going to happen. But it's reasonable to think perhaps 2 hikes this year, but that will still take us to minus 20 basis points. It will still be negative. Okay, and then so that upset the European bond markets. You had the Bank of England go first with 25 basis points, 4 dissenters wanting half a point. That started to rock the bond markets a little bit. Then the press conference out of the ECB, and you basically had, God knows how many sigma move it was in 2-year bobbles, 2-year German government bonds, but they basically went up over 20 basis points in a couple of hours, terminating early this morning, and they've stayed elevated. And then, you had this non-farm payroll data. Everybody got it wrong. And the thing is, if you're worried, if you think this month's figures are nonsense, well, look at the revision.
Sorry, when you mentioned the NFP data, what's important about the NFP data? Because I think some people looked at the headline employment numbers, some people looked at the wage rates. So can you tell us what's important there?
2 things. One is nobody was expecting a non-farm payroll ad like this. Some people will say, well, it's always going to be revised. Well, okay, then look at the near 400,000 upward revision for December. It's all their data, the way it's coming out. Now, the BLS isn't necessarily the best, but everything that they look at is strong labor market. The thing that really upset the bond market was the average hourly earnings, 5.7%. To Albert's point last week, wage inflation is here to stay. So having been inundated with calls this morning, that really affects what the Fed, the Fed actually are fighting for their credibility.
So you say wage inflation is here to stay, but it's really is the Fed trying to break the back of wage inflation?
Well, that's something they could impact, right? By weakening the demand side of the markets. We'll have another idea on inflation next week, the CPI. And the lowest forecast is 7%. The highest is 7.6. They're not getting the favorable comparisons because oil has continued to move up, energy's continued to move up, right? So assuming we've got a 7 big handle, and help us if we have hit the 8 handle at all, this Fed has no choice, because as you can see with the bond market's going to do the Fed's job if they don't do it. So every time so what you had over the last couple of days with a bit of pullback before the ECB, you had a bit of pullback by some of the Fed members, the FOMC members, and the yield curve steepened.
Nick, right? I got a question for you, Nick. Can you buy bonds if the oil goes vertical? Because I think we both think that oil is going 120 north.
Yeah. Well, no. I think that's another reason why you can't be long bonds at the moment. And the bond market will adjust to it. And this is not, everybody said the bond vigilantes are dead. when you look at the percentage moves in the price of the bonds, they're not. These are big moves going up.
I don't know. Nick, can you address a little bit about like what will happen to the credit markets as far as the bond
Well,
movement?
funnily enough, high yield seemed to do okay today, which, investment grade, fine. That should, historically in rising rates, you should see investment grade do somewhat better. High yield, no. High yield, I mean, if these rates are going to start moving up, and some of the stuff I heard today tells me one and done is not going to happen. It's going to be more, and they're not going to have a choice. And these central banks have been basically what you had in the last 7-8 days is the central banks admitting they made a policy error or two last year. And now they're fearful of making further policy errors. So they've got to be seen to do. And again, to Albert's point last week, clearly the Biden administration have their backs on the inflation front. And I suspect, from what I was being told, we're going to be quite surprised at potentially how aggressive this Fed could be. Not 50 basis points in March. That will be too quick, too much too quick.
Okay.
But June, May, June could well be in play because these numbers aren't coming down. They're just not coming down.
Okay. So regardless, Q2 is when things start to happen on the interest rate front, on the rates front, right?
Yeah. And in terms of QT, I was told today, second half, beginning of the second half.
Second half. So does that mean July or November?
It probably means July,
Okay.
given all the stuff I was given.
I honestly think it's a possibility we do that beforehand, just because fiscal cliff is coming in March. They got to
But
do
how do they
something.
go from QE to QT just like that?
They shouldn't be
How do they
doing QE
justify
right
that?
now anyway. I mean, that's the extraordinary thing. They're still doing QE. So they've
Right.
missed a beat
Yeah.
there.
How do you taper if you're doing QE still?
Right.
Why doesn't anybody ask that question or answer it?
I ask it every week.
I mean, this
They
is-
wouldn't be
I
invited
mean,
back to the conference.
You know, Tony, I was on this thing with Andreas, and we're gonna taper. I'm like, okay, sure, on paper, but the reality is you're not, because the QE is continuous.
It has been.
I don't know seems to me from what Nick's saying, it may not be continuous. It seems like that has to stop because the policy position is it's going to stop in March, right?
Exactly.
So,
Which is why I think 25 basis points, not 50. However, I think right now, until they've caught up somewhat, forward guidance is not going to be with clarity. They want to get back to normal so they can be forward guiding according to what we were used to in the deflationary times, pre-COVID. Okay.
so when you say pre-COVID, you mean pre-COVID in terms of interest rate and balance sheet?
Yeah, I think it's exactly what I've been told this morning. They want to get back to the interest rate level that was prevalent then. They want their balance sheet back at that level.
Okay.
And I think that what's happened is not only have they been shocked by inflation, they shouldn't be shocked by the paucity of their forecasts, but I think they're shocked by the fact that we've got a lot of bubbles going on. Equity market, value, housing market. So NFTs.
Crude oil.
Crude oil is not a bubble. Bonds,
No, I'm kidding.
bonds are a bubble. Bonds have been a bubble. So, I think we've got some surprise. And of course, that will then feed in. Remember I said originally, there's either a riot in the bond market or a riot in equity market.
That's right.
One
2
or
weeks
the
ago.
other. It started with bonds, and then we got a bit of an equity riot yesterday, which was more earnings related. But the thing about it is, if you look at interest rates as gravity, zero interest rates with basically zero gravity. So you're on the moon, equity value, equity stocks have been up here. If they're raising rates, they're increasing the level of gravity. And Newton's law means that something starts to fall.
Nick,
I was also told if it's not a cascade, if it's orderly, sort of down 20% from here, they're okay with it.
Okay, 20% from here.
Yeah, the Fed
That puts us at what, 36?
600, 35, 3,600,
Okay,
which is still above where we were before COVID, right?
right.
Fed will be happy with it. This put is not, there's no clarity on the put anymore.
Okay, so is it safe to say that your view by the end of the year is sometime between now and the end of the year, we'll hit 3,600?
Look, the Fed these rate markets will carry on. Any mistake by the Fed, any hesitation, It's going to be punished by rates. And you've seen what's happening, and it happens, it crosses over. You saw what happened in the European bond market as well this Thursday. Bank of England, you saw gilts market also adjust, and that flowed through to the US market, and it continued today.
So do you think the
Because-
10-year crosses 2% next week?
Oh yeah, I mean, my target on the 10-year for this year is 260, 2.6.
Okay, great. So
Okay.
let's take that and as central banks react to inflation, Tracy, we're seeing crude prices just kind of a rocket ship. So can you talk us through that and let us know, how does that contribute to next week's CPI? And Nick mentioned CPI, but what do you expect for that as well?
Well, I mean, I expect CPI to be high. However, the Fed doesn't really include energy and housing in there and food in their metrics. So that doesn't necessarily play into that. That said, I think what we saw today was a lot of shorts being squeezed out of the market. That said, still expecting higher crude prices later this year into, Q2 and Q3. The reason being because the global oil inventories just drew another 8 million. We have OPEC that just announced another 400K increase for next month this week, right? And they haven't even been able to keep up with their production increases. I mean, their compliance is over 132% right now. They just don't have the spare capacity to move forward. US products consumed last week hit 21.6 million barrels. That's over 2019 levels. So globally, we're seeing higher demand with lower supplies. So this market is likely to continue higher just because of actual supply and demand issues, which I've been talking about week over week. What's also interesting today is that nobody's really talking about is that Saudi Aramco just announced that they're mulling another 50 billion equity stake sale, right? And so it would behoove them to keep kind of oil prices higher and inventories kind of lower, right? So
Sure, yeah.
there's a lot going on in the market right now.
Okay. And as we see this cold front come through different parts of the US, of course, it's winter, but do you expect, say, nat gas to continue to rally, or say for the next couple of weeks or next couple of months, or do you expect that we're kind of in the zone where we're going to be through the winter?
I mean, I think we're kind of in the zone. The US nat gas prices are not as subject to the volatility or the constraints that,
Right.
say, European nat gas prices are concerned. I mean, we have an overabundance of nat gas, right? We tend to flare it. We're going to be this year the world's largest exporter, right? But that's not necessarily going to bring, I mean, you have to look at our nat gas prices trading at $4 or $5 compared to nat gas prices in Europe trading at, $40. So I think that we're, I think we're at a sideways market right now, just because of the oversupply that we have. What we are saying is, depending on what area you live in, then natural gas prices tend to vary. So if we're looking at the Northeast, for example, where we have this cold front, nat gas prices are at $11 there, right? But Henry Hub, which is what everybody's trading, is still at 4 or 5. We're going to see nat gas prices rise in Texas right now because we have a cold front coming through. But, again, that's a regional market.
Okay. I was just complaining about gasoline prices being $3 here in Texas earlier today. So, I just can't deal with it. Where is it where you guys are?
425 in Tampa.
425. Holy cow. What about you, Tracy?
$3.99 in the Northeast. Right now.
Wow. Like we're right at $3 and I can barely stand it. Okay, let's move along to some geopolitical stuff. So, of course, Ukraine is on everyone's mind, and I think we've seen and we'll put a link to this in the show description. the video from the State Department spokesman and the AP diplomacy reporter. Albert, can you talk us through a little bit of that, kind of what's happening there, and what is that doing to the situation to find a diplomatic solution?
Well, I mean, simplistically, I mean, you have the Biden administration trying to amp up the rhetoric and make it more dramatic, basically to distract from what's going on domestically in the United States, from inflation and, you know, social issues and SCOTUS picks and, you know, down the list of the problems that are facing the Biden administration. That exchange was, I mean, unbelievable. I mean, you had an AP reporter just taking him to task and saying, where's the declassified information? And his response was, I'm telling you verbally right now, and that's the declassified information. That's just that's unbelievable. You're not gonna get away with that. And this is just more of a symptom of the ineptitude of Anthony Blinken as Secretary of State. He shouldn't even be called Secretary of State anymore. It should be Secretary of Statements, because that's all he does. He doesn't do anything else. And when it concerning Ukraine and his, you know, method for, you know, quote unquote diplomacy, he's a non-factor. The United States is a non-factor right now. They're behind the eight ball, where they keep talking up this rhetoric and putting their allies in Europe, you know, behind the black ball here. It's like, what do we do here? We need support from the United States to show strength, but realistically, we can't stop them going into Ukraine.
Okay. Yeah, so let's just go on to a viewer question here from @Sachin Krunger. He says, what will happen if there is an actual escalation between Russia and Ukraine? You know, what's the likelihood of actual escalation, and what do you think would happen? Both you and Tracy, you know, part of it is commodity prices. Is there an impact on commodity supply chains, and meaning wheat and gas and other stuff to Europe or other places, or is that not necessarily a huge issue?
Well, I believe that we're about 75% that they're going to have some sort of incursion into Ukraine. I mean, you don't mobilize that many people and create supply chain logistics to not do anything. That question really depends on the level of incursion, right? Because if it's just 10, 20,000,
it goes back to Biden's minor incursion thing.
Yeah,
right?
but I mean, that's you know, that's the Pentagon's working model, and that's my working model. It's like, you know, 10, 20,000, you go in the same places you were before, you loot the countryside, cause a little disturbance, the West looks weak, you leave after a month or so, right? Mm-hmm. That's the likeliest situation. Of course, you know, the markets are going to freak out in day one, first couple hours.
Exactly what I was going to say. I mean, obviously, you're going to see a reaction in the commodities markets, just because, you know, we've had 4 years of really not much geopolitical risk factored into a lot of these markets, the agricultural markets, the energy market, right? I mean, pretty much after Libya had a ceasefire in 2020, all that risk premium kind of came out of at least the energy markets. And in the agricultural markets, we haven't really seen a lot of geopolitical risk. So of course the markets will freak out. I totally agree with Albert on this point. You know, whether that's going to last or not, that's a totally different story.
Yeah, I also think that we've had so much money supply that cushions geopolitical risk on some level, and interest rates have been so low that cushions geopolitical risk as well. So, you know, as we're in this interest rate cycle and this balance sheet cycle, geopolitical risk counts for more. It's more costly for companies. It's more costly for countries and investors. Does that make sense?
I would add one other thing. These markets are not trading liquidly. So these moves on geopolitical risk could be exaggerated. Right?
Could
just not
exactly. That's exactly my point. Is that any geopolitical risk will be exaggerated at this point,
because there's just. I mean, you can see there's no liquidity, right?
Yeah, to be fair, any kind of event right now just makes the markets look like it's a crypto exchange.
Right.
You know, 30% on, you know, 30% up, 30% down, 300 points on the ES. That's insane. You know,
on that, Albert, let's move to some tech earnings, and let's talk about Facebook and Amazon. So if we want to talk about big moves, can you know, everyone kind of knows this, but can you Can you talk us through a little bit of that? But I'm more interested in why it's happening. Why is everyone negative on Meta and why are they positive on Amazon?
Well, from my perspective, the Fed and their cohorts use maybe a dozen companies to pump the markets, right? They're mainly tech, right? They've expanded out into a few other things, but it's mainly tech. Facebook being one of them, Amazon being another, AMD and Google and all these guys, right? All these big tech names.
Mhm.
Now, when you see Facebook miss and a couple other miss, and the markets start to get weak, right? There's a point to where, and this goes back to what Nick says about different levels in the markets and whatnot. He always stresses that with me. There's a point to where if they break this level, right, we're going down to 4,100 or 4,000 or 30, God forbid, 3,900, right? So when that lined up right when Amazon's earnings were coming out, and I'm looking at the market and I'm looking at these levels and I'm like, there is absolutely no way they're going to allow Amazon to miss, whether they let them cook the books or say something in guidance or whatnot. And lo and behold, what happened? Amazon beat. Did they
Epic.
really beat? Probably not. You know what I mean? But
And then a few price increases as well.
yeah, and then Pinterest that nobody cares about beats, and then Snapchat that I don't even know what the hell why they're a company. They beat unbelievably. I think they were up like 50-60% in after hours, right? So now they have their juice to pump the markets back up to 45.30 or even maybe 4,600 next week before the fiscal cliff becomes a problem.
Okay, so
Well, I mean, you also have to look at the bond market, right? I mean, the more the 10-year tanks, the more that's going to drag on tech in
Newton's
general.
gravity.
right. So what does that tell us about the next couple of weeks, specifically next week, but the next couple of weeks? So as we've seen, say, Meta come down, Facebook come down, but we've seen these other things really rally. Where is tech as a sector?
It's a pump.
Interest
It's a
rates.
pump. It's a pump sector. That's all it is right now. There's nothing really behind it. It's built on zero rates. Well, we know we're going to get rate hikes. So what are you betting on at the moment?
Right. That's the basis of my question. If tech is a deflation play and we're in an inflationary environment and we're going to have rate rises, what does that mean for tech in the near term? So are we at the kind of tail end of tech? That's my real question.
We're at the tail end whilst we have to see these interest rate rises come through. And actually, you don't necessarily have to see the central banks officially raise, because if they don't, the bond markets are
Right.
for them. And then there'll be a catch up. This is the problem. If they underperform in their credibility catch up, because they've already implicitly admitted their errors of policy,
Mhm.
bond market will adjust and they have to catch up again. Now, if they do something surprising on the rate side, so yesterday was an ECB shock, right? Today, there was nothing to do with the Fed. It was the data. Well, we've got that CPI data next week, right? That's going to be very interesting. Because actually, I agree with Tracy. Core is at a certain level, which is still too high. But it's the full Monty, the full CPI that labor uses when they're discussing their wage claims. It has
Right.
to be. That's the
So-
behavioral economics.
CPI is the single biggest event next week. Is that fair to say?
Yeah.
Mhm.
Yep.
Okay. Okay. So let's look at that. So what if it is, say, 7, which is kind of the expectation, I guess the lower bound of expectation, kind of, right? So let's say it's 7, or let's say it's even 5. What does that mean for us? Does that mean continued easy Fed, or does that mean you have the same assumptions and that's just kind of a milestone or something that we're passing along the way to higher rates anyway?
We're on the way to higher rates anyway.
Okay.
We have-
I mean, if
Okay.
it's 5, the market temporarily will probably rally because that lessens the effect that the Fed's going to raise, right? That percentage will probably go down. But that's a temporary, if we're just talking about market reaction on the data release. I don't really see that happening. I mean, I don't see 5% coming in. I don't see
Okay.
that, that a
Okay.
possibility, but that, no.
Then let's look at the
Yeah,
other
also-
side. What if it's 8.5? What happens then?
Well, then in the old days, it would have been an intermeeting rate hike,
Okay.
right? And the bond market will just It'll be another riot. Even if the core is steady, big figure 8 on the full CPI, that would shock a few people. Like people were shocked today with the non-farm payroll data.
Right.
Literally, if you could watch Bloomberg TV, it was like
Right.
they couldn't believe what was going on.
So we're in that place in the market where the porridge has to be just right. Is that fair to say?
I think we're in for volatility, right? I mean, we've been experiencing volatility for the last month or so. I think this will continue until March, until we have some resolution of whether the Fed is going to raise rates or not. In between, it's going to be volatile because everybody's looking at intermittent data saying,
Right.
does this mean the Fed's going to raise rates? Does this mean the Fed's going to look? You know what I mean? So I
Okay.
think we're in that push-pull thing. And I think that volatility will continue into next week. I think that volatility will continue into actually the March meeting until we get some resolution whether the Fed is going to raise rates and by how much.
Okay, so if I, just a couple of things for you to agree or disagree with, just short yes, no. Next week, volatility in equities with downside bias. You agree or disagree?
Disagree.
Disagree. Nick, you agree or
Disagree.
disagree? Downside bias, you agree. Tracy,
Aye.
equities, agree or disagree?
I think it depends on the sector.
Okay. Give me one or two.
So I think we'll see a downside. My downside bias is in tech and then obviously ES because it's heavy tech,
Yeah.
right? And so I think we see sideways markets in the Dow and the Russell.
Okay, then let's do the same exercise for commodities. I know there's a lot of commodities out there, but generally commodities, choppy with an upside bias. Agree or disagree?
Agreed.
Agreed.
That's a dollar call.
Okay, explain that.
Surged yesterday because of the dollar's weakness against the euro and the Dixie. I tend to agree with you. I think it's going to be choppy until we see the color of that CPI number.
Okay, very good. Anything else to add for the week ahead?
Just keep your eyes on the bond market.
Keep your
That's
eyes on the
my-
bond market.
My mantra.
Very good. Okay,
Keep your
guys.
eyes on BCom.
Thanks, guys. Thanks very much. Have a great weekend and have a great week ahead. Thank you.
All right.
Thank you.
I don't know. The left side of my screen is the pineapple people. That side of my screen is the non-pineapple people.
Kidding me?
Nick, you gotta
the
stay
Sultan's
strong, brother.
pineapple.
We're gonna call Nick Luke for the episode today.
Oh,
Oh,
dang.
stop.
Okay. Okay.
Let's call me the
First.
professional.
The professional version of Luke.
Okay.
Anyways, I'm done joking. Let's get this
Okay.
thing on the road
Let's
because I got
get
stuff to
it
do.
done. Okay, good. All right.